All right, good afternoon. Can everybody hear me okay? All right, excellent. Well, this is my first time attending this event, and I feel like I'm the kid who's been invited to the cool kids table at the cafeteria. I'm from Philadelphia, and I work in credit scoring, and you guys are working on some pretty amazing stuff. And what I've been hearing and learning is technology is rapidly evolving. There's new types of payment systems, new currencies, new assets, some next to Snoop Dogg's house apparently in the metaverse. So there's new forms of engagement between the consumers and the merchants and the financial institutions, and tons of data is being created. I'm a data scientist. I love data, so I like this. So I'm coming from the credit scoring side of the world, and credit scores are not new. They've been around for a few decades, but we also have the need to innovate, look at new data, and really respond to all of these changes, particularly looking at consumers and how they're interacting with their financial institutions and merchants and their behaviors. So I'll talk a little bit about that. So the first thing, this was covered in the morning, but it's just, I think, a point of connection between what we do versus what you all were talking about this morning. That in January, you may have heard that VantageScore, through the partnership with TransUnion and Spring Labs, it was the first credit score that was made available through a digital wallet in the blockchain. So along the lines of providing better outcomes for consumers and lenders, creating that opportunity to transact. This is one example how innovation and technology and data can be used to facilitate that. So that was just one point of connection. But when we think about VantageScore, here's our mission statement, and if I don't put this here, Sylvia will be upset with me. So our mission statement emphasizes three things: being the most predictive credit scoring model, being the most innovative credit scoring model, and being the most inclusive credit scoring model. So these relate to one another, and in the next few slides, I'll talk about each of them a little bit. But the innovation part in how we are achieving the most predictive scoring models and the most inclusive credit scoring models, it's been in our DNA that we've been constantly trying to innovate and do better. So if you're not familiar with VantageScore, just a 30-second overview. We've been around about 16 years now. We were created by the three credit bureaus, Experian, Equifax, and TransUnion. We're an independently managed organization. About 2,500 institutions, including 2,200 lenders, use us. So we are used pretty much everywhere in the financial system. In a span of 12 months, this is from 2019, 12.3 billion Vantage scores were generated. So, we are being used a lot, anywhere from credit decisioning to segmentation to account management. Vantage scores are widely used. 9 of the top 10 banks use VantageScore. Many of the financial technology firms, many of the credit unions leverage VantageScore models. So going back to innovation, the way I think about it is that we've been innovating in a number of different fronts. We've been innovative in the types of data we're using. VantageScore was the first tri-bureau model that leveraged rent information, utility information, telecom information to really be able to score more consumers and to be able to score them more accurately. We've been also able to innovate in terms of technology, in terms of methodologies. We've been using AI and machine learning in really developing the models so that we can make best of the available tools to really improve the accuracy of our models. We've been also innovative in ways that are more friendly to consumers, such as we've eliminated certain things from how the scores are calculated. Paid collections, for example, were removed. You may have heard there was an announcement just a few days ago about how medical collections, paid and unpaid, will be handled in the credit bureaus. VantageScore, for a long time has not been using paid medical collections in its score calculations, and we've been weighing unpaid medical collections much less than other types of collections activity, because that's consumer friendly. Plus, it's actually, from an empirical perspective, that makes sense. We've also created ways to make things simpler for consumers. So if you get a credit score, and if you want to understand why you get that score, there's a website you can go. You can look at your reason code, and you can understand in plain English what you can do to improve your score. By the way, I should say, since 2016, you can get your VantageScore freely from many of those direct-to-consumer websites. And we were the first commercial credit score that was made available to consumers freely, primarily emphasizing the need to better educate consumers so that they can take better control of their financial lives. And lastly, for financial institutions, a number of innovations we've done is just along the lines of really increasing transparency. These tools don't need to be black boxes. We provide information on how these models are constructed, how they perform, and we share that information with many of the financial institutions that are using our models. So that's my spiel on innovation. And I think this slide, it will take a while for me to explain this, but I think this slide explains why innovation is important, because this would be the result of, if you don't innovate, what happens. So there are other models in the industry that are used. Our competition, namely one, they have been around for decades, and they really haven't changed some of their practices in decades. So what that means is that all of these changes in consumer behavior, all of these changes we've been talking about, new data becoming available, they don't get into that algorithm. So as a result, what happens is that you create a disconnect between consumers' behavior today, how consumers are interacting with credit today, versus what the algorithms are expecting them to do. So what we see is that as a result, there's a significant population that's been left out of these, what we call conventional models, or essentially older models. So you may have, how many of you have heard the term credit invisible? It's yeah, so a number of you have heard it. So typically it's referred that about 45 to 50 million consumers are credit invisible, i.e. they do not get a credit score, but that's not true. They do not get a credit score by these older models, because those models are really not using the data and the tools available in the best way they can. We've done research last year, which was really trying to understand who gets impacted by these older models. Where do we see the most impact felt? And what we've seen is that there's actually 4 factors that explain who can receive a score and who does not receive a score through these older models. So 4 factors: your income, your race, whether you own a home or you rent, and whether you have access to financial services, i.e. is there a bank in your community? All of these factors play a role, and all of these factors play an incremental role in whether or not you're getting access to credit via having a credit score. The biggest impact is income. That explains a lot of the differences. But then if you are coming from an African American or Hispanic background, if you're a renter, and if you just don't have daily access to a brick and mortar bank in your community, your odds of getting a credit score through these older models are less than half compared to another individual who will not have these disadvantages. Now, you can ask, of course, from a financial inclusion and equity perspective, it's not hard to imagine that lower income communities, minority communities, communities that have been disadvantaged and underserved for many, many years by financial institutions are basically most adversely impacted by this. And there is a way to solve for this, and we've actually solved for this, and I'm going to talk a little bit about that. But here's why this is important, because if you don't have access to credit, Credit is basically the #1 driver of building intergenerational wealth. When you look at how in the United States, consumers live the American dream and basically build up their wealth for their children, it starts with having access to reasonably priced credit products, mainstream credit products. Here's a few statistics here. These are all quite striking in my view. First of all, as I mentioned, as I hinted, access to brick and mortar financial services is much more limited in minority communities. That's just researched and published in a number of different resources. What we've also seen from our research is that African American and Hispanics are significantly lower in terms of percentages with a credit score. In fact, about 78% of African Americans and Hispanics do have a credit score. That's about 5 to 6% below the overall population. When you think about who's using payday loans or title loans, those loans that have crazy high interest rates, the African American and Hispanic populations are disproportionately using these services because they do not have other choices in their communities. Mortgage denial rates, when you look at who's getting a mortgage and who's not, even for between qualified applicants, minority populations have about two times higher denial rates in their mortgage applications. And when they get mortgages, they tend to pay higher interest rates compared to what are the ongoing market rates. Beyond consumer, we see similar trends in small business lending. In fact, the applications for small business loans are twice as likely to be denied if the small business owner is an African American. And home ownership, this is the big story of our day, right? So when you look at home ownership rates overall, I think it's about 66% home ownership rate in the United States across different households. That's about 72% for white households. And that's only about 42% for Hispanics and 39% for African Americans. So there's a wide gap in home ownership, and home is the primary asset through which you're basically transferring your wealth to your children. And net worth, coming all of this, when you look at the average net worth or the median net worth for whites versus non-whites, there's about an 8x difference. So I think you get the picture. Access to credit is important. Having a credit score is your key to gaining access to credit. Therefore, credit scores are important. And that's why I guess we're in this business. So I said we have a solution for this. So simply by using better data, better methodology, we've actually addressed that credit invisible situation. Out of that 45-50 million number that's been often quoted, we actually we can score about 37 million more consumers than those legacy or older models that are used in the industry. So in fact, we can score about 96% of all consumers 18 years or older. So that's a significant impact. And this map shows overall US level is about 14.5%, but you can see that state to state, those numbers differ. The darker shades of the map shows where those percentages, newly scorable consumers, are higher. Not surprisingly, in areas where the macroeconomic conditions are worse, where the socioeconomic conditions suggest more of a disadvantage, you can see higher percentages. And we can dive into this a lot more granularly, looking at MSA by MSA, community by community. You're going to see very striking stories where in certain neighborhoods, you can actually see one in 3 adults being newly scored just by using better data and better technology. So the opportunity is there, the solution is there. So we just need to make sure that lenders are adopting these newer technologies. Here's kind of like the way I talk about this, and this is sort of how you can break this self-reinforcing loop of not having access and really allow consumers access to credit just simply by using better data, better technology. Here's the negative loop I'm worried about. If you don't have a score today, that means you don't have access to mainstream credit products. If you don't have access to mainstream credit products, you go to a payday lender, you go to a title lender, or you pay through the nose with higher interest rates. And that puts more strain on your financial situation. That only increases your chances of basically failing to meet your financial obligations, and that pushes you even farther away from the mainstream financial services. So the way to break that is by providing a fair and accurate assessment of your risk, having a credit score. And with that, you can get access to responsibly underwritten credit products, establish your history, demonstrate your ability to keep up with your obligations, graduate to more complex, more sophisticated products over time, and keep on building. Even if you're not ready for credit on day one, you at least know where you stand. You at least know what you need to do to improve, because your score is there, your reasons are there, you can connect the dots, and you can try to make better decisions for yourself. So that's basically why we think having a fair score for as many consumers as possible is the right thing to do. And the way we do that is basically by applying better data, bringing more data in, bringing better methodology in. But I should say, we are a risk management tool. We are not, our primary objective is not only to score more consumers, but we are measured on the merits of how well we score those consumers and how well our models do. So I have a couple of pictures here for the data geeks in the room. What I'm showing here is that when you're applying better data and methodology, you can actually get superior results. It's pretty straightforward. On the left-hand side, what I take is our model versus another generic credit scoring model available from the credit bureaus, and put them side by side for new accounts being originated, as well as existing accounts for bank card, auto, mortgage, and installment loans. And you can see that consistently, our models are doing much better compared to the more traditional generic credit scoring models. Again, the secret is not a secret, it's basically better methodology and better data being applied. Now, when I share this information with financial institutions, they also ask me, well, how well your performance stays over time, like with COVID and everything we're living through, can you show that I can actually rely on this tool? The right-hand side shows that, yes, that score to risk relationship is maintained. So my model's main objective is to be able to show you there's a rank ordering. I can provide the relative risk of an individual compared to everyone else that's being scored at that time. And that relationship is very stable. That's been working. So that gives lenders comfort and confidence that these tools are actually very, very effective. So looking ahead, like where we sit today, when I talk about this topic in different forums and discussing like what to expect, what keeps us up at night, those kind of things, I see that our business is a very dynamic business, right? So consumer behavior is dynamic, economy is dynamic. There's a lot of changes happening. So these four buckets are like what I keep thinking about. First, consumer behavior, and many of your earlier presentations sort of covered this. We see that consumers' behavior have been significantly changing over time. The digital first engagement is becoming the norm. There's new forms of payments, new forms of credit. Like we've been talking a lot about buy now, pay later loans recently. That's just one example. What we observe is that younger generations have a much different understanding of credits, much different appetite for credit. Gen Zs and millennials and how they're interacting with credit is different than my age group, for example. And we see that payment hierarchy changes over time, especially in times of stress. You might be prioritizing your mortgage payment in one scenario, but you might want to shift that to your auto payment in another scenario. So these are dynamic behaviors. On the macro environment where we sit today, we read about rising inflation. We read about increasing interest rates. We read about Ukraine and everything going on and the implications in terms of what will happen with the economy and all of the disruptions that may continue to cause. And lastly, how does all of that affect different consumer populations differently? Some of these things will affect younger generations, lower income consumers, less educated consumers, hourly workers versus professional workers. Those dynamics are going to be very different. So those are the type of things I worry about in terms of the macro environment. And post-COVID, this is everything that I'm sure you're following. There's a lot of changes either happening or about to happen. Student loans, which is about what, $1.5 trillion. They have not been, 86% of student loans, which are owned by the federal government, they were not required to make a single payment since the beginning of the pandemic. That deferment has been now extended until, expected to be extended until the end of the year. And the question is, what happens to those consumers when those payment requirements resume? Or are there going to be other changes that will need to occur there? So that's a question mark for us. Similarly, maybe to a lesser degree, forbearances on mortgages. There's still some out there because of the pandemic. And other things like, going back to normals in terms of saving rates and ending unemployment benefits and things like that. There is a lot of temporary things that were introduced to the system that are now going away or changing. So, it begs the question, how do we account for those and what kind of data we need to address that in our models? And finally, I'm the data scientist. Let's talk about changes in data. There are changes in the data that we are receiving. We talked about medical debt. We talked about potentially student loan data changing. BNPL, other types of products being developed every day, and they're going to be coming into the scores one way or another. Open banking, you guys know about this more than I do, but open banking is a big deal because now you're going away from a setup where the data is owned by the few and is shared by the few to a setup where vast amounts of data may become available on consumers to really enrich how we are able to model with this information. And related to that, there are new and growing sources of alternative data. How do we account for all of that? So this is kind of like what makes our job fun, I guess, in terms of really thinking about these pieces. And on our side, when we think about data, we are constantly looking for new types of data, right? We talked about rent and cell phone and utility, those type of things where they are available, we go and we get them and we try to use them. Personal cash flow data, consumer permission data coming from financial institutions. That's a key area of interest for us and for many other people to really look at not only one side of the balance sheet, but also look at the other side and understand what assets and liabilities, understanding cash flows. Buy now, pay later, and other forms of relationships that are popping out there. So our fundamental goal here is really to understand all of these new and evolving sources of data and how we can make best use of that. So I will end with this one because ultimately models are built on this basic premise that past is going to be indicative of the future. But that's a very, very strong assumption. And we know that future is full of uncertainty. So it is hard to make predictions about the future. So that makes it interesting for us because we're not only trying to understand what from the history is going to be relevant, how we can enrich our understanding of that historical data so that we can apply it, but at the same time, we're trying to also adjust for what might be changing in the future with respect to behaviors, new forms of relationships, new types of merchants and financial tools and assets. So that's my little presentation here. So I'll stop here and we can go to the questions.
Great.
Thank you.
Excellent. Thank you so much. So I think you've given us a lot to think about, just about the dynamics. And when you look at the dynamics of the market, and just when you look at that list, right, really gets you thinking about, wow, how much has been changing. Why do you think credit scoring has not kept up with the inherent dynamics of the market?
So it's interesting because financial institutions tend to be very, very cautious about change. And they tend to be also highly, highly regulated in terms of, some of these tools and data and scores that they're using. So what I observe is that the cycle to adopt new and innovative tools for particularly the larger organizations tend to be slow because of all of the governance and change management, as well as some of the legacy operational and technology systems that they will need to change to adapt that. What we are observing is that some of the more recent players, like the fintechs, who don't have that baggage of historical legacy systems, they have been much more quick to adapt some of these changes. So I think it's just a different story depending on what type of institution you're looking at.
Yeah. How can credit scores, to get back to kind of the topic of today around cryptocurrency, how can credit scores facilitate better decisioning in cryptocurrency and uncollateralized lending?
Yeah, so I mean, we were talking about this earlier and a little bit over the lunch break as well. But again, I think this, if you have a higher degree of confidence in terms of the risk of the counterparty you are interacting with, and if that's made available to you in the form of a credit score in that type of an environment, I think it just mimics what you do in a normal financial setup. So I think that reduces the friction cost by providing more certainty, more information to the lender versus the borrower in that type of a transaction in terms of the credit quality. And I think that can only help reduce either collateral requirements or other specifications of that particular engagement.
Yeah. What do you think is the next big trend to expect in credit scoring to help assess consumer worthiness?
Yeah, so I think we've been talking a lot about all of these alternative sources of data. Traditionally, VantageScore, as well as many other credit scoring models out there, have been largely built from centralized credit files that the 3 national credit bureaus maintain. And more, there's an interest in really expanding beyond that and trying to really provide more of a 360 view of the consumer. In my mind, one big area in that discussion is really about bank transaction information, permission data, where consumers can opt in as part of a process to make more information available about their financial situation, so that the lender can obtain a better picture of perhaps looking at their cash flow, types of transactions, balances, to get not only an understanding of how they have performed historically on their financial obligations, but to have an understanding of their capacity to pay and the totality of their picture. I think that's kind of like the next frontier. There's a lot to be still sorted out on that front, but I think there's a lot of excitement about it.
Yeah. And how reliable are credit scores in measuring risk, especially when this environment is changing so rapidly? To your point with student loans, I mean, that's a big shock to the system. Unemployment benefits, I mean, those are all big shocks to the system.
Yeah, I mean, based on all of the analysis that we have been doing at our end, the credit scoring models are fundamentally continuing to do the job that they're supposed to do, which is rank ordering risk. So at a high level, the models are still reliable. We haven't seen a significant enough shift in consumer behavior to make credit scores ineffective. However, I always say I'm a risk manager, right? So I always say whoever is relying on these tools will need to assess at a fairly granular level of detail for their own portfolios, not only the top level performance, but looking at different segments, different population groups to really understand, are there areas where things might be perhaps lagging, or there might be issues in terms of performance. So in times like this, monitoring is only more important to really be on top of how not only credit scores, but all of our decisioning tools are working.
Yeah. Any questions from the audience?
Hi, Jill Moser with Bank of America. I am curious if there's any early leading indicators based on, some current things from an economic standpoint that are coming, true student loan forbearance and lots of, programs that were, given out and now are, kind of coming to a close. What are you seeing from a risk management perspective in terms of credit scores, and how is that affecting, large population sets?
Yeah, and I have a lot of data to share on that, so I can get your information afterwards and send you a whole package on this. But at a high level, what we've been seeing is that, first of all, credit scores have been fairly stable in the last now 7-8 months now. In the early stages of the pandemic, we've seen an increase in credit scores because of primarily lower usage of credits, and because also of all of the accommodations and changes in reporting of delinquencies and things like that. They have kind of reached a plateau and they've been fairly stable. We've been observing balances, utilization levels, as well as delinquencies across different consumer segments. Compared to pre-pandemic, general picture still looks pretty positive. Delinquency levels, even for assets that have been now way beyond the accommodations, are still well below where they were pre-pandemic. Credit usage has been, has lagged for a long period of time. Now we're finally seeing that the balances have caught up and are comparable to where they were before the pandemic. And same for like new credit activity. We have seen early on a lot of the lenders pulled back, and a lot of the borrowers gotten really conservative about getting new credit, particularly with credit card and personal loans. We have seen for the first time in more than a couple of years, in the last 2 months, they finally sort of caught back up to where they needed to be. So that's kind of all the positive. When we look at some of the more granular consumer segments, one area that I have a question mark around is on the younger populations. What I'm observing is that in the unsecured types of products, when I look at Gen Zs and millennials, I do see that they are showing levels of delinquency that are perhaps higher than where things were pre-pandemic. And I'm also seeing that their balance growth has been higher than some of the other populations. So that suggests to me that perhaps there's an early sign of stress there. And every month new data comes, every month I basically look at that. But that's kind of like the general story. Overall, fairly positive. Some questions for some smaller consumer segments, particularly on the younger side.
Hi, Farrell Hudzik, CardLinx. I am curious to get your thoughts on the big banks are starting to share transaction data. You mentioned that and how that's going to be helpful, but they're actually starting to share transaction data amongst themselves to be able to make decisions where they didn't have available credit. I'm curious as to kind of how you see that trend progressing with the Akoyas of the world. And do you think, not to be controversial, but do you think that that could potentially even replace some of the credit bureau and scoring activity of the decades and decades?
Yeah, I mean, that's a great question. So yes, recently we've seen larger financial institutions are beginning to share that data among themselves through EWS. I think that the scope of that exercise for the time being is fairly limited to cases where there is no credit information available on that consumer. But to your point, that could certainly be expanded. I think the financial institutions will need to decide the benefit of sharing versus benefit of keeping to themselves. And to your point, yes, if that sharing occurs, that creates an alternative point of view on that consumer compared to what you might be getting from other places like the credit bureau. I do think that credit bureau data is still very, very powerful, particularly for consumers with established credit history. So I think it's going to be hard to overtake that completely. But I think in areas where perhaps the information is more limited, like the thin file consumers or maybe the lower income consumers who may not have as much activity. So I think that's where the play is going to be in terms of really, figuring out different strategies there. Oh, Sylvia is asking the question. I'm in trouble.
This is a tough one, but I just have to ask, like, there's been so many different types of new data sets that have been discussed so far. I'm just interested in your perspective as a data scientist, which is the one that's been most interesting? Like, you've heard about so many different data sets. Which one would you be like, I'd love to have this because it would totally make boost predictive power for VantageScore?
Yeah, I mean, there's a lot of interesting data sources, but again, I have to say that I'm bound by FCRA and what I can and then I cannot use in this context of a credit decision-making process. So I think the more of a complete picture of the consumer I can get from the data, the better it is for me. So I would be, I think top of that list is cash flow and perhaps employment and assets information. So those are clearly going to be highly predictive in terms of ultimately what our models are trying to do, which is assessing the likelihood of somebody not being able to keep up with their payments. So that's what I would choose.
Any other questions? All right. Well, thank you so much.